Okay, what's good, everybody? Welcome to today's higher time frame session, and we've got Jean here. And what I'm going to be covering today is the seasonal tendencies of currency pairs. So today we're going to be going over seasonal tendencies and how this can be applied to you as a swing trader, also as a position trader, and also as an aiding tool in your higher time frame analysis. Um, Trading with the seasonals is also one very vital tool that you need to have in your arsenal as a higher time frame trader trying to catch position trading setups, swing trading setups, and also short term trading setups. So with that being said, let's get down into today's session. All right. So first off, I'm going to try to explain what seasonals are in my own words to break it out as simple as possible for every of you guys so that you can understand what seasonals are and how to apply them in trading. All right, so first off, let's go with the definition. Okay, so what is seasonals? Right, so seasonals are simply a time period in a year where a currency is most likely to trade in one direction based off historical price analysis. Okay, so I'm gonna repeat myself. I'm sorry if I clear my throat. I've got a cough, slight cough, so I'm trying to hold it so as not to distract you guys. Um, okay, so seasonals provide trade conditions over a period of time each year where a particular asset is most likely to trade in one direction for that period. Okay, so this can provide very excellent swing setups, also excellent position trading setups, especially if these periods line up with market structure, also the market trend, the tone of the marketplace. Once this all lines up, you can get really, really explosive moves in the marketplace using this. So it's very vital as a position trader, also as a swing trader, to have in your arsenal seasonal tendencies. Okay, so using the word seasonal tendencies simply means it's a tendency during the season of the year whereby the asset class can most likely move in one direction based off what historical price data has shown us. Okay, so now in utilizing seasonal tendencies, the idea is that if there is an expected bearishness in a particular season, okay, so and the question you need to ask yourself, okay, is market structure backing up the bearish in the marketplace? Once you get that kind of situation whereby market structure is backing up bearish is now bearish direction in the marketplace, also in line with a period of the year whereby you expect the market to go bearish, that is an absolutely loaded deal for you. It's an absolutely loaded trade for you. Okay, so now using the seasonal tendencies is not meant to be a all. It's not meant to be an all-in-all kind of approach trading whereby every season you expect the market to exactly give you the same thing. What we're trying to do is we're trying to filter out as institutional traders what is most likely to be out in the marketplace over a period of time. Okay, so and we're trying to figure that out by looking at past price action, past price data to understand how the market behaves around the season. Okay, and know how we can approach the market if the seasonal tendencies lines up with our technicals, which is our normal analysis, market structure analysis, and all that. So with that being said, let's look at a few examples and let's look at how this can be applied to trading. So what I'm gonna do real quick is to go to my Explorer where there's some PDFs for some seasonal tendencies. Okay, and what I'm also going to do in this video is to do a quick intro into what 10-year treasury notes are and how important the 10-year treasury notes are to you as a trader. So before we cover the 10-year treasury notes, I'm going to break down what 10-year treasury notes are. So the 10-year treasury note is a futures contract which shows the US Treasuries, the investment inflow into the US Treasuries. Okay, and you can easily find this by going to www.barchart.com. You're going to see subsequent videos of me doing analysis using the 10-year Treasury note. But for today, we're just going to be doing quick entry into what the 10-year Treasury notes are. And then in the next video, I'm going to go into details how to utilize 10-year Treasury notes to track smart money, buying and selling and investments into let's see, currency asset classes. Okay, so we're trying to track investment inflow or influx into currency asset classes using the 10-year Treasury notes. All right, so the 10-year Treasury note simply does the opposite to the DXY. The 10-year Treasury note is simply inverted to yield. Okay, so yield and interest rates align the same way. The market direction of a currency pair is always or usually going to be inverted to that of the 10-year Treasury notes, because the 10-year Treasury notes is like that of interest rates. So as you all know, as institutional traders, smart money likes to follow where the yield is, and yield is determined by interest rates. So long-term fundamentals of a currency pair is determined by interest rate. Higher the interest rate, higher the currency prices. Lower the interest rate, lower the currency prices. And the central banks do set the interest rates of a currency, right? So the central bank set the interest rates of currency, and interest rates is basically like the main fundamentals into trading the forex market, forex niche, right? So if interest rate is rallying, you want to see the currency rally higher. Interest rates is dropping, you want to see the currencies also drop as in respect to the interest rates. Now, interest rate also shows where yields are, and if you know the yields, meaning what is the percentage or what is the return, the ROI on the investment you can get on an asset class, which is what is called yield. Okay, so this is why you hear people want to invest in higher yielding asset classes. So assets classes which brings more yield, and you're gonna get higher yields when the interest rate is higher, right? So let's say, for example, the DXY has high interest rates. That is going to lead to higher yield, which is going to lead automatically to investment, to an influx of investment, because people are seeking asset classes where there's higher yield. And then if the interest rates drops, then you're going to get lower yield, which is going to cause about a bearish tone on the DXY, because it's going to be a removal or withdrawal of interest in that asset class, in this case the DXY, which is going to reduce the influx of investment into that asset class. So hopefully this clarifies that for people who have confusions about the interest rates and the yield. Okay, so you can track interest rates and yields simply by looking at the Treasury notes, especially the 10-year Treasury notes. Okay, so if money is being removed from the yield, higher yielding asset classes, okay, it is going to pour into the US Treasury notes. Okay, so these two are like constantly opposing each other, right? So if 10-year Treasury notes is rising or rallying, you want to see the DXY dropping, because DXY is going to be a reflection of the yield of that currency pair. Okay, so if 10-year Treasury notes is rising or rallying, that means I want you guys to think about this conceptually, right? So if 10-year Treasury notes is rising, what does that mean? It simply means that the yield is dropping, and people or investors no longer look at that asset class as, okay, this is an higher yielding asset class, and they will then withdraw from that asset class and want to put your money into a different asset class. In this case, the US Treasury notes, which can be tracked by the 10-year Treasury notes, right? So if the 10-year Treasury notes is dropping, then you want to see the yield, also the currency, in this case the DXY, also rally, which is going to be a true reflection of the constant war or the influx of buying and selling in the marketplace. So in the next video, we're going to get into more details about the relationship between the yield, the Treasury notes, the yield, interest rates, and the currency asset classes. But for this session, I want to cover mainly the seasonal tendencies, and if you look at historical price data on the years, the 10-year treasury notes. Okay, or in this case here we have the 30-year treasury bonds. All right, so you can see around, treasury bonds are also the same as treasury notes. Okay, so we can see around January to March. Now I want you to look up and see it's a 30-year treasury bond, 40-year seasonal tendency, right? So the lines you're seeing here have been averaged out over a 40-year period. So what you're seeing on this black line is a historical price action of the 30-year treasury bonds over a 40-year period. Now, if you look at the red dotted line, that is the historical price data for the treasury bonds over a 15-year period. Right, then the blue line, the thin blue line, which is also dotted, is historical price data for the treasury bonds over a 5-year period. Right, so now what we want to look at first is we want to look at the overall average price over the last 40-year and over the last 15-year and over the last 5-year, so we can then begin to spot the differences and know what we can do as traders, what decisions we can make as institutional traders going forward. So now if you look at the 40-year pattern, okay, which is simply the average of all yearly movements on the treasury bonds over a 40-year period, you can see around January to February to March, the 30-year treasury bond is bearish. Then going into March, April, May, that is when it is most seasonally can make its lows. And then from around May, you're going to see an exponential rise on the treasury bonds. As I just explained, the treasury bonds do the opposite to what the DXY does. Okay, so the treasury bonds and the DXY are like opposite of each other. So they do the opposite to each other. So if treasury bonds is rallying, you want to see DXY dropping. If treasury bonds dropping, you want to see DXY rallying. Okay, so now if you notice what is going on the blue dotted line, okay, on the 5-year period, you can see how the lows, which often came around May, okay, the lows of the year which came around May, has now shifted into March. So now around March is when you're most likely to get the low of the year based off past, not the low of the year actually, because price is coming from below. So is when you're most likely to get a seasonal low, not the low of the year actually, sorry. Okay, so if you look at March, the beginning of March is when you're most likely to get a seasonal low based off the last 5-year price action. Okay, and then you get an exponential rally from around March to mid-April, and then the rally starts to taper off going into May, and then price consolidates in the mid months of the year. Now, if we understand that the 30-year treasury bond does opposite to what the DXY does, so we do expect that if the 30-year treasury bond is most likely to make a low around March, then we want to expect the DXY to most likely make a high around March. If we want to see them do, or if we assume they're diametrically opposed, meaning we want to see them do the opposite of each other, then this is what we want to see. Okay, so now if you look at the DXY, and this is a 33-year seasonal price chart of the DXY from 1985 to 2017 is what you're seeing here. And if you look at January going to February, there's an exponential rise into March, which is where you get the high of the year around March, mid-March going into early May. Okay, so what's going on? Right, so from mid-March going into early May is when you're most likely to get your seasonal low. So now we can see the correlation between the treasury bonds and the DXY. Right, so the analogy I gave whereby investment is moving from either the DXY to treasury bond to DXY is correct, because we now understand that just these two asset classes are both diametrically opposed. We want to see them do the opposite thing to each other. Okay, so now we understand that around March to May is when we're most likely to see on a seasonal premise, we're most likely to see bearishness on the dollar. So what I want to do is I want to go to our chart to see if that actually all correlates. So what I'm going to do is I'm going to start with I went back all the way to '09, which is 2009. Let's see what price did around that period. Okay. Okay. All right. So now we can see around March '09 that price was bullish. Okay. This is why I said you need to have a market structure first before you then begin. Oh, this is actually pound USD. Sorry, that was pound USD. I meant to do DXY. Pardon. It's pound USD. Let's do DXY. Alright, I don't know. This is like my second laptop, so this is gonna hang a bit because I don't really want to get new one yet. Because the other one is currently in use, the third one is currently in use, so I just had this option to use it. So this laptop might be pretty slow, so I just want you guys to bear with me on this. This is like the oldest of all the laptops, so I just decided to work with this as others were in use. Okay, with that being said, let's look at what the DXY is on. Right, so we have this is March '09 on the DXY. Like we said, seasonal tendency. We want to see March bearish around. Want to see March bearish around March. So not March, sorry. Want to see DXY bearish around March going into May, right? So now, if you translate that into real candlestick price action, you can see from March going into May, there was this bearishness in the DXY. And by the way, guys, this is a weekly time frame, so you know how many pips this is on a weekly basis, right? Now, if you also look at the DXY, right, you would notice around June, July, that there is also another seasonal bearishness on DXY going into October. Okay, especially during bearish years. Okay, so during bullish years, you're gonna get the low around August, which is what you see on the 5-year pattern. The low comes in around August and all the way into the end of the year. But during bearish years, you want to see the high of another seasonal high from around June, July, and then drop off into October. So now, if we translate that into price data, this was a bearish year. Price is obviously bearish, and then we can see another seasonal high from around June going into October, which is when we see another seasonal high form, and we get this bearishness. By the way, guys, this is a weekly time frame. Look how massive this drop was. And if we go to the next year, March 2010, okay, so we have a bullish seasonal, okay, on the DXY. We saw bullish price action from March going into the first week of April, sorry, May. We saw bullish price action from March going into the first week of May. But now, if you also look at the second seasonal time period where we can most likely expect bearish price action, which is around mid-June to July, going all the way into mid-October. This is what you see right here. You see around 28th of June, price starts to drop off going into mid-October and then creates the low of the year before it rallies. And now the next year, we also see the bearish seasonal or the bearish price action on DXY from March going into the first week of May. And then also the second seasonal, bearish seasonal we want to see on DXY slightly came in around July, 1st of July. We said that bearishness, then a low was created around August. Okay, so now if you refer back to what I mentioned about the 5-year pattern, okay, if you want to see a bullish year, you want to see that bullish year form around August, which is exactly what you see on DXY. So we saw that bullishness from around August, and you can see this was the open of the year, this was the close of the year. So this was a bullish year on the DXY. And look how precisely accurate we got to getting the low of the DXY from August, and there was explosive price action going into the end of the year like we saw on our seasonals. Okay, so again, we look at the next year. We're looking for basically bearish price action on from March going into early May. But now, if you look at the underlying tone in the marketplace, price was bullish, so there was no reason why we should be expecting, or we would have been expecting bearishness, because underlying market tone was bullishness. All right, but now we can look at this around. We can look at this price action around mid-July, okay, where there was basically a torso back of old highs, and we saw price willingness to trade lower around this period. And if we analyze that with seasonal tendencies, this was an excellent setup, because this is a weekly time frame. So this was an excellent setup for bearish prices on DXY. So this was another clean setup, and basically price was not really changed on March of 2013. But if you look at July, okay, look at the July. After price created, basically equalized around this level. Price came down to the level, went up to this level, and if we know around this period that we can expect bearish price on the DXY due to seasonal tendency in line with market structure, look how it all lines up, and we get an explosive move to the downside for months. So this on pound USD could be 2,000 pips, 3,000 pips, 4,000 pips. This is how you get your position trading, guys. This is how you get your position trading setups. This is also how you get your swing trading setups and your short-term trading setups. So for a period of time, you know what you're doing. You know you're only looking for sells in the marketplace. Only sells, not buys. All right. So now if we go to the next one, this was a bullish year on DXY. So we were not going to expect any, although we do have the benefit of hindsight, but if we're doing this all on live price action, we should not have been expecting, or even if we were expecting any bearishness in the marketplace. Once price broke this prior high around this level and retested via this candle, okay, we knew, or we should know, that this is going to be a bullish year. And if we missed this, okay, this is basically August, right? And I said you can expect a seasonal low to form around August. So look how this low came around August, where price basically retested old highs before the rally into the end of the year, which is what you see around this level. So look how seasonal tendency is putting everything in perspective. What seasonal tendencies actually is giving you the time basis. Okay, this is the time period of the year where you should be doing this. So and so month you want to be doing this. So and so month you also want to be doing this. So everything's beginning to get clearer as regards to higher time frame trading. Right. So now if you look at the next year, is there a reason why you want to be bearish by March? Okay, now not using the time factor now. Okay, is there anything you're seeing that want to make you bearish? Is there price action that you're seeing that's telling you that you can expect bearishness? For example, is there a massive rally on a 10-year treasury note? Okay, is there a massive rally on the 10-year treasury note? The price straight back into a monthly order block, a monthly premium level. All that factor, once you get that bearish, once you get, arrive at the conclusion that you're going to see bearish tone in the marketplace, and you then line that up with seasonals, okay, you then know that you're looking for bearishness until the first week of May, which is what you see around this level. Look how time accurate we were in identifying the highs and lows of this range. Also around mid-July, mid-June going into early July, you want to see another low, which is what you see around this level. There's clean lows around this level, and then there was a weekly bearish order block around this level. Price simply came to that level and went for those clean lows. So that was an explosive move for you guys, okay, using seasonal tendencies. March, the same thing. You get your bearishness. In this case, July, there was slightly bit of bearishness, but since the year was bullish, look where the lows came out again. August, okay, lows came around August, and then bullishness into the end of the year. Again, March bearishness. This was a bearish year. March bearishness, then mid, June, July bearishness, also using seasonal tendencies. And now this was a bullish year. If this is a bullish year, we're looking for the lows to come in around August. Let's look for August. Okay, so this was around the August time period, which is where we had another seasonal low around the August time period, then price rally into the end of the year. And okay, so we're looking for August again. This was a bullish year. August time period rally before price then dropped. Okay, guys. So if finally, the next question is how do you utilize this to trade the other currency pairs, right? So now, if you know where the DXY is going to go, that helps you 60% of your trading because you know where the other currency pairs want to go. If the DXY is going bearish, you know what the other currency pairs are going to do, right? So now, if you translate that into British pound, you can see around March that is when price is most likely to make seasonal low on the British pound and then rally into the beginning of May. All right, so if you look at the British pound, you can see all the shaded boxes are all the seasonals. Okay, so look how price is rallying. The only time in a seasonal frame of mind where you can expect British price action on the pound USD is March going into early May, which is what you see here. Bullishness, slightly bullish or bearish. Remember, you need to factor in market tone, which is all what you see here. Bullish price action, bullish price action. By the way, guys, this is a weekly time frame, so you can understand how explosive these moves are, right? So if you caught the low of this week going into the high of this week, right? That was a 785 pip move. 785 pip move. This move was about a 700 pip move. So this is how you can use seasonals to get really explosive price moves. Okay, so this was about 1,479 pip move. Alright guys, so that brings us to the conclusion for today's lesson on seasonal tendencies. What I'll be doing is once I drop this video on the group, I'll send a PDF file containing all seasonal tendencies of all currency pairs, courtesy of Texas trader Bailey, who sent it to me as I had difficulties trying to find it online. Right, so I'm going to send it to you guys, and you guys can use that to practice. You can use that to study, and you can use that to start to incorporate that into your trading. So with that being said, guys, see you next time. Trade safe.